Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Again, when we talk about gamma, remember, the more you go up, the longer you become. The more you go down, the shorter you become. That's if you're long gamma in this particular instance, okay? Now, in this instance right here, it's a little bit different because you actually have an exposure on the market. But if on the euro from 147 to 151, you can still sell the underlying because your delta is rising with that position. In essence, if the euro explodes and goes from 147 to 160, okay, in the spot market, all right, the value of that call spread you have on, the value of that collar, will increase dramatically, almost to a point that it's almost reached its full value. It will never quite be at its full value until like expiration day, but it still adjusts accordingly. So I tell people, like, even if you're trading call spreads, you can still trade around using the underlying spot market to offset that risk. Now, Steve, at the top of the show, asked about, well, John, you talked about implied volatility being kind of high, and I think that the safest way, or maybe the most judicious way of playing that volatility skew, which we can't really get into tonight, but something that is worth noting, meaning that what are the implied volatilities on the front month calls out there right now, and what are the implied volatilities on the back month calls? And that volatility skew, or that difference between front month volatility pricing and back month volatility pricing, has created some opportunities, I think, in some of these markets, okay? Because I don't think they've adjusted quite fast enough to maybe what we've seen a little bit of compression recently. Definitely, if you look at a chart of the euro spot market right now, if you look at a chart of the S&P spot market, we've seen a lot of range, but I think things may begin to compress a little bit. So a way to play that is that if with the front month volatility being still pretty richly priced, is some calendar spreads. And what calendar spreads are, selling an option in the same vehicle in 1 month while purchasing an option in a more distant month. At least that's if you short the calendar spread. Well, actually, you'd be long in that instance because you'd be paying more, but that's fine. So in this case, you can sell an October EUI call for 203 as an example, and then buy a December EUI call for 333, or a $120 debit. Pardon the typo there. And the difference would be naked to calls, but gamma shifts depending on the range of the front month contract. So if I think that the euro spot euro will go to is going to trade about where it's at right now. And let's say I'm longer term bullish and it sells down, well, there's a lot of ways for me to put that into play here. And you'll see when we look at this chart here, this short calendar spread, or short the front month calendar spread, looks very similar to a straddle or a strangle, except there's a third dimension to this trade which goes a little bit, which adds sort of the third degree or fourth degree of level when it comes to trading these options. And that is, in this case right here, these options expire, and after they expire, you still own the back month call. So there's a lot of ways that you can benefit from this. So let's say if the euro goes to 145.50, okay, in the spot market, that's ways away from there now, clearly, 2 full dimes. But if it rallies to 145 and sits there, or it goes to 145, well, those October calls can expire worthless, and those D's calls will have a lot of value behind them. All right, in this case here. So as it stands right now, we have the December calls out there that are they can expire this week, and if you want to build maybe a January exposure, you can sell some December calls. You can buy some January calls, and if the market goes down, you can have some January calls built into your portfolio. Okay, call spreads and put spreads. We talked about. I sort of touched on this a little bit earlier, but with the collar position, kind of the same thing you accomplish from that, and that is the simultaneous purchase and sale of a lower price call and a higher price call. These can be done on the screen. Again, Interactive Brokers is the first brokerage firm that comes to mind when I think about initiating these option spreads through ICE, and clearly, whatever your respective opinion on the market is, if you think the market's going higher, a great way to play that with this high implied volatility right now. I know that it sits on the euro somewhere near 22, 23, 24 in there. As little as 6 months ago, that was down to 11 or 12. So we've literally had a doubling of implied volatility in the deepest exchange market in the world between the euro and U.S. dollar. The owner of the bull call spread will buy the lower price call, or the lower price call, and sell the higher price call and create a debit to the account. Put spreads function the same way. You may not be bullish a particular market right now. You may not be bear. You may be slightly bullish, but not super bullish. In that case, it may be more conducive for you to put on a bull put spread, and so on and so forth. The question was asked about a butterfly, and in essence, a butterfly is a combination of a call spread and a put spread. In essence, like you think the market's going to trade within a certain range. You could sell the 130 spot Euro FX call spread, buy the 135. You can then, actually that would be an iron condor, but you could then sell the 125 and buy the 120. And you're basically looking for the market to trade within the 125 to 130 range of the spot Euro FX, and work that accordingly. So those are just some ideas right there based on what's happening. I think the euro is going to trade in a range, but I think it's going to be, I don't know. I wouldn't be surprised if we saw the euro come and touch 120 in December sometime, the 120 handle. But then, I'm not sure we're going to make that next precipitous break lower after that. And then from there, maybe we settle out and do that. But overall, I think December is going to be a pretty wild month. And I think maybe gold gets one more pullback in here, and then from there we put a base in and rally. But, I don't think the deflation sentiment that exists in the market right now it's dissipated over the last week. I'm not sure if that's more holiday-induced than anything else. But really, Monday and Tuesday this week, guys, I hate to be so general and cliche-ish, but I think Monday and Tuesday this week are going to really give us the insight and the heads up as far as what we can expect to get out of the markets for the next couple of weeks. We've had a really robust rally in the last 6 or 7 trading days. We've seen the S&P come off lows really well. We've seen the spot euro try and touch the 130. We did pull back quite a bit on Friday, but I'm not sure with the thin trading that went on how exacerbated that was. And so if you're going to put on these strategies, putting them on through these defined risk parameters, through further compartmentalization of the risk of your portfolio, it's going to really give you guys some insight and really give you guys an edge to objectively trade these markets. And that's one thing that I can't emphasize enough, is that keeping your emotional cool, knowing what your risk parameters are, knowing how they're defined is invaluable in that regard. Here's a screen layout. The software that I use to trade these, at least to analyze these, is the CQG. It's very user-friendly. I throw a chart up there. I type the stuff in. This could also be done on Interactive Brokers as well, but just trying to give you guys a little bit of insight of what I use. We talked about, positive scalps versus pain decay, and in essence, we go back to the straddle position here, and working that as far as, well, okay, I'm long gamma right now. Can I basically pay back my theta rent or my time decay, and the time that I'm long this respective position? Okay, some questions I ask myself, like, gosh, right now, what positions do I have on right now? Well, I'm long gold. I'm long a gold straddle. I'm also short a Euro FX straddle because of the Euro straddle because of when it expires at the 127.5 handle right now. We'll see if I end up taking a dirt nap on that. I'm also in a bull put spread on the yen as well. So, those are the 3 positions I'm working right now, and they all end up weaving back into the S&P and into the fixed income markets. And what I'm looking for, and I just sound so lame, but I just can't help it, but I think that the last shoe to drop in this whole credit thing really goes to the 30-year treasuries. And they're way too strong right now for me to get short, but I think in the next 3 to 6 months, when this deflationary bug gets out of the market, that being short the 30 years could be the trade of 2009, because we're sitting near the 127 handle now. I wouldn't be surprised if it's back into the 110, 108 handle. Well, you got to keep in mind the way these futures contracts roll on there, but I think that's a big spot for us to look at. So went over the 3 positions I'm in right now, but with all those positions, this is the question I ask myself before I put them on. 1, what's my exposure? Am I bullish, bearish, neutral on price volatility? How old do I think I can trade this spread? Because that's a big key. If the market that I'm trading isn't in a big rhythm, then that's not a spread I probably want to put on. Okay, and then where do I think volatility is going? And then is the market in rhythm? So, this is the strategy we use in my fund, Net Black Capital, and this is how we build exposure and sit in front of institutions and articulate what it is that we do and either scare them or they become more interested. flexibility and strategies. I talked about this earlier, but I want to revisit this point. A lot of people out there like playing breakouts, like playing their trend followers and whatnot. A short straddle can serve as a hedge for a market, in a market that lacks trend or direction. Now, others might say, well, John, why don't you just not trade those markets and not have to worry about that? Well, that's absolutely true. That's absolutely true. But if we all knew when a market was going to stop trending, we'd all be rich.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.